All right, we are recording. Has everybody got their cozy coffee for this fireside
Yeah.
chat?
Yes.
Cheers.
Cheers.
Cheers. I even put on my sweater so I could stay warm next to the fire.
It got cloudy for us, so it feels kind of holiday, wintry
Yes.
vibes.
We timed it perfectly
I
for
know.
Oregon.
All right, well, we will give it about another 30 seconds to a minute, and then we will get started to talk about this juicy subject. I'm kind of excited.
Yes.
It's coming up fast.
It is coming. How many days is it? It's got to be
Oh, we
around,
got like less than a month and a half.
like, yeah, I think
November
I
5th.
heard 50 yesterday.
Yep.
I think this is one of our most well-attended webinars. We did this back, goodness, in 2020. Was that 4 years ago?
Yes.
All right. Hello, everyone. Welcome to our election fireside chat. It is officially the top of the hour, so we will get started. We are thrilled to be here today to talk about how the election impacts your investments and your financial future. And I will say that this is being recorded so that we can ensure that we get the replays out and get it to all who can't be here live with us today. But we really love to have people live with us because we get that interaction and just feel that energy that you're all in this with us, because we are all investors in the markets during this election. Okay, so you today get a treat with the three of us. So myself, Julia Carlson, I am the CEO and founder of Financial Freedom Wealth Management Group. And I'll share a little bit more about me as I go here. And then you have Jason. Jason, say hello.
Hello, everyone. My name is Jason Harris. I'm the president of Financial Freedom Wealth Management Group. And I'm certainly delighted to be on this nice, cozy fireside chat with you all.
Yes, and he is streaming in from our Corvallis office. Jason has been with us for over 10 years. He is a certified financial planner, a graduate of Oregon State University, go Beavers,
Yes.
and received his MBA in finance from Walden University. Jason has substantial experience in financial systems and money management, understanding and working with many of today's challenges, like navigating investments through an election year. He plays an active role in his community in Corvallis, being a part of the chamber, his church, and I know serves on various boards and finance committees over there. He enjoys in his spare time, I know, spending time with his wonderful wife, Angel, and their three children. And then we have DJ. Where is DJ? Say hello.
Hello, hello, everyone.
DJ is tuning in from our Eugene, Oregon office. He is the director of investments and as well as a financial advisor with our team. He received his bachelor's degree from the University of Oregon. So we have Go Ducks.
Way to play it down the middle today, Julia. You got beavers, ducks, Good work.
Where he focused his studies at the University of Oregon in economics and business. DJ loves to discover and monitor the investment opportunities, and he is instrumental in crafting our various portfolios used in a lot of our clients and almost all of our clients in investment portfolios. He serves clients across the nation and is passionate about providing guidance to help people pursue financial freedom. Outside the office, DJ enjoys outdoor sports and spending time with his wonderful wife, Cecilia, and their two sons. All right, well, let's get started here. A little bit about Financial Freedom Wealth Management Group. I founded the company back in 2001, right after the turn of the century. Goodness, that makes me feel old. We are a comprehensive wealth management and planning firm committed to helping our clients improve their long-term success and pursue financial freedom. We serve clients from all walks of life. A lot of what we do is that pre and post retirement. So as you're leading up to retirement, what does it look like? How do you build and protect your wealth then into retirement? And we serve a lot of clients in retirement. We also help people developing and growing their wealth and making sure that they're getting started out in life and through life on a strong financial footing. And then we also serve, most of our offices are in rural Oregon, and we are really helping business owners, making sure that they are putting their financial future in place as they build their business. And our commitment is to care deeply about you and your financial life. Now, here is our amazing team that serves all of our clients. Some of the newest team members are not here, but right now we're about 22 team members. We have 7 financial advisors and 15 support staff. We have 4 offices located in Oregon, but then we also serve clients virtually across the states. I think we have 40 or 45 states that we represent in our helping our clients. So today we are going to talk about the election and really look at history and what does history have to tell us around election years and the impact of markets. And then we really wanted this to be a way that you can engage with us. We want to hear your questions, get those answered in what we're calling a fireside chat. So with that, I will show you on this screen. If you look at the bottom, it says text your questions to 458-777-4458. Now, due to compliance, we can't have an active chat on this Zoom webinar, but we do want to hear from you. So if you want to warm up the chat, as we like to call it, you can either text in where you're tuning in from. If you already know you have a burning question, then you can text those questions in to that number. And as we go along here, that number will be on the bottom. At any point, give us questions. And then we have set aside time at the end to make sure that those are all answered for you. All right, now, all of us here at Financial Freedom, especially the advisors, have conversations every day with clients. And some of our clients have very strong political views and opinions. So I don't know, is that any of you guys out there? Do you have strong opinions? Well, as a reminder, I want to say, as we go through this data today, let's zoom out. And one thing I like to say is, we are not investing in our government. A lot of our investments are invested in publicly traded companies. Yes, that have to abide by the policies and what the legislation puts out, but we are investing in strong companies. And so with that, I will turn this over to DJ, and he is going to get us started here.
Thanks, Julia. So, I mean, anytime we're in an election year, I think that's going to cause some uncertainty for a lot of people. It's perfectly normal. So that's very common. You're not alone if that's happening to you. And I mean, it's an uncertain situation. You know, we're going through an election. We don't know the outcome. We don't know what's going to happen. And so that can cause, a little anxiety. And of course, we know that markets don't like uncertainty. And so I know we could kind of connect that and say, okay, there's some unknowns happening with the election that might affect my investment. So perfectly normal. We're going to go through some of the data today to show you what we've seen in the past. So first, we're going to kind of zoom out, like Julia mentioned, and look at the big picture here. So this graph takes us back to 1926. That's basically as far back as we can confirm stock market data. And this gives you the growth of $1. So if you invested $1 back in 1926, so almost 100 years ago, what it would grow to during that period. So through 2022, your $1 grew to just about $10,000. Pretty amazing, pretty good growth. It's about a 10% per year return. Now, we've had a whole bunch of different presidents during that period. We've had tons of elections. You can see here that it kind of goes back and forth. You see a lot of red, blue, red, blue. And the stock market doesn't really care who's in the White House. That's just the truth of it. Yes, like Julia mentioned, there's going to be some policy changes and things that, companies are going to have to adjust to, but they'll do just that. They will adjust. They are flexible. They find ways to make money no matter who's in the White House. They're really good at doing that. They're going to continue to create new products. They're going to continue to grow their earnings. They will adjust where they need to. And if all that happens, you're going to continue to see the stock market go up over time. Now, of course, there's ups and downs along the way. I mean, that is normal. That's the investing experience. But if you're in it for the long haul, history tells us that the stock market keeps going up. And so that's important to remember, right? I know we can get really focused in what's happening right now. And especially, if you're on one side and the other side wins, that can be a little unsettling. But try to separate your investment strategy and your politics. It is easier said than done. But what we found is that's the best way to set yourself up for success for your financial future.
Yeah, just
DJ.
looking. Oh, go ahead, Jason.
Go ahead, Julia. I love our little chat time. What's interesting is I think when we ascribe to a certain side of the aisle, we sometimes come in with that bias that okay, either my side is always going to be up, or if something happens, the other side gets in, it's always going to be a bad thing. But like you're saying, I love that approach that we got to separate that from our thinking because we're investing in companies and not in the actual country.
Yeah, just looking at this chart, I've been through 5 presidents. I got first licensed in 1998. And so it's been really interesting if I zoom out and look at, the blue and the red, there's you can find good in all of it. And I think that's the thing is you have to keep focused on the fundamentals, on the stocks, on the investments. And I love what you said, DJ, not abandon your investment strategy due to politics.
Mm-hmm. Right.
Yeah.
And actually, well, it's okay, we switched, but there's only been twice during that period where the market has been down during a president's tenure. And that was back in the Great Depression. So Hoover, you can see, and that was just really bad timing for him.
Mm-hmm.
And then in 2008 with the great, the financial crisis, those are the only 2 times here where the market was down. And those were 2 extreme periods, right? It wasn't anything the president did. It was just kind of, the way it worked out. But every other time, the market has increased during the president's tenure in the White House. Okay, and this one is it's kind of the similar data that we just saw, only broken up per their term, per the president's term in office. And you can see here, these are annualized returns for each 4-year term. And the main thing here is that most of them are positive. There's only been a handful of times where we've actually been negative during even a 4-year term. Again, we had Hoover with the Great Depression, and that was a really tough time. And we had, the 2008 deal. But for the majority of the rest of these, really solid performance during each 4-year period. Interesting here, you can see Roosevelt, that was our last 3-term president. Obviously, haven't had that since, but that's interesting to see there. But yeah, the markets, again, they continue to go up. They can handle the change in politics. That's what democracy is, right? It's give and take. We try new things, we go back and forth, and markets have responded really well to that. All right, and this one here, this is really going to be kind of an extreme example. So what this is showing, going back to 1950, if you only invested while a Democrat was in the White House, or if you only invested while a Republican was in the White House, you can see the growth for those. 1 million doesn't really grow much at all. You're really, that would not be a good approach. And I don't think many people do that, but it gives the point across that that is not a good strategy. If you stay invested the whole time, that's what that top line is going to be. And your 1 million turns into 32 million. So phenomenal growth if you just stay invested through it all. And again, I've never heard of anybody saying, I'm only going to invest during one type of president. But I have heard of people they get concerned and they may want to shift to cash or make some changes to kind of get through a period. And even that can have a pretty big effect negatively on your financial success. So you really want to make sure that you're staying the course, that you have your investments set up well to handle the ups and downs and the uncertainties that the markets experience, and stick with it long term. And that's going to give you the best chance of success over time. All right, so we've kind of looked at the big picture there. Now we're going to talk a little bit about the specific election years, which of course we are, almost through this election year. And what's amazing, even with all the uncertainty that election years bring, and again, markets don't love uncertainty. That's a big thing. Even if something bad's going to happen, once they know that it's happened, they can move past it. But even with all the uncertainty, election years have been better than your average year. So you can see that the average gain during an election year has been about 11.5%, going back to 1928. Whereas the average of all years has been just about 10%. So we've actually experienced better growth on average during election years. And if we look here at this chart, you can kind of scroll through it. There's only been a couple. So we had Roosevelt, where we were down during that election year. 1940, we were then down. And then we did not have a negative election year until 2000. From 1940 all the way until 2000, we did not have a negative returning, in the stock market, a negative year during the election year. That's a long period of time. It's pretty amazing. And then, of course, 2000, that was the dot-com bubble. And then we were negative again in 2008. But only a few times. And if you look here on the right side, 83% of the time, we've had a positive return in the stock market during an election year. And this bottom right corner, this is probably the most amazing stat. And this even surprised me. During election years, the first half of the year, the average gain has been 2.78%. Whereas in the second half of the year, during the actual election, the average gain has been over 9%. I was surprised by that. Even during the election, while we're going through all of that, that has been the strongest period for the stock market during these election years.
Yeah, and looks like we're on track as well this year for it to be another positive election year. First half has been 14% for the S&P.
There you go.
Which is crazy. And then from July until now, it's been about 4.5%. So, if we want to keep these stats going, we'll have some good gains, hopefully, as we close out the year. But this is really good to see, because in my mind, it's always negative, right? The election year is going to be negative, but clearly the data shows that's not the case.
Right. All right, and then we can dive even deeper, still focusing on election years, and we can look at the average gains quarter by quarter. So we can actually do a comparison to what we've done this year. But going back to what we saw previously, on average, the first half is a little bit slower, and you can see that here. So the orange bar is during these presidential election years. The average gain in the first quarter has been lower than normal, 1.3% versus 2.5% for all years. And then you get into the second quarter and kind of similar story, right? Average gain of 1.5% versus 3.4% for all years. Now we get into that second half of the year and things start to really pick up. In the third quarter, that's been the strongest, really that lead up to the election. The average gain has been over 6% in that third quarter, while your average gain for all year has been less than 2.5. So that third quarter has been particularly strong for the stock market. And then the fourth quarter also pretty good, you know, kind of through the election. And once we know what happens, kind of finishing up the year, the average has been pretty close to all years. So over 3% gain. And, you know, the end of the year generally is a strong time for the market. It is the strongest quarter.
Yeah, which is, it goes against our natural feelings, right? We tend to be like, I don't know, I'll just do nothing until after the election because then I'll know. But you actually miss out if you have that behavior, you know, based on historical stats. So it happens a lot in markets. Our natural instincts is actually against what we should be doing.
For sure. And even if we look at this year, the numbers are higher than even these averages. So we haven't had a sluggish first half. Like Q1 has been about 10%, Q2 4%, and then we haven't quite finished the quarter, but Q3 is tracking to be about 5%. So not the sluggishness that we're seeing, but also we're seeing higher numbers for this election year. So kind of interesting.
Okay, now we're going to kind of dive into, you know, what's happened right before the election and then right after. So if we look 3 months before Election Day, going back to 1972, the market has gained 1.5%. So for those 3 months, so what is that, like August, early August up to Election Day, November 5th, we've seen on average 1.5% gain. So nothing massive, but pretty solid still, 1.5% gain. This is where it gets really interesting though. The 3 months after Election Day. So now we know what happened, right? Whether you're happy or not, right? We know what's going to happen. We know who was elected. The average gain has been 5% for the 3 months following Election Day, which is really good growth, really good growth. So again, it's just kind of showing that the data says that, you know, markets, they kind of digest this stuff really well and respond favorably to whatever happens.
Yeah, it reminds me of what you said earlier, DJ. It's that certainty. The market has certainty at that point, and then it can just move ahead.
Yeah, and I know we had looked at, you know, where we're at now. We're about halfway. So we're a month and a half into this 3 month total of 3 months before. And already, so that would be August 5th, the market has seen a 10% gain from August 5th. So quite a big difference, you know, even from the historical averages. Again, it's looking very positive. We'll see what the next month and a half does, but from what we're seeing, it is actually looking quite nice.
Yeah, I mean, that's this year. So we know election years are great, but this year, like you're saying, Jason, has been even better than average. I mean, it's just been a really strong year.
Yeah.
All right, this is a great chart here. And now we're going to really just focus on after the election, really just after, you know, after we go through the election. So going back to, you know, mid 80s, we can look at what the market has done, stock market's done, you know, 1 day, 1 month, 3 months, 6 months, and a whole year after Election Day. So when you look at the day after, it's basically a flip of a coin. You can see that here, right? Kind of half and half, you know, whether the market's going to be up or down, which is kind of typical for any given day. You know, it's could be up, could be down. And the average gain has been, you know, down 0.5% right after the election. Now you look out 1 month and the numbers are starting to look a little bit better. You know, now it's more likely that we're positive. So there's just been 4 times here where we've actually been negative a whole month after the election. Now, when you look at the average, it's still down 0.5% 1 month after, but it's really 2008 that negative 16% that's really pulling those numbers down. The median gain is positive, about 1.5%. Now we're at 3 months after the election, and things are looking very good. So we've been positive every time except twice, 2000 and 2008, with an average gain of 3.5% and a median gain of about 5.5%. So 3 months looks really good. And it just keeps getting better. So 6 months after, again, same 2 years that are kind of the outliers there, 2000 and 2008, but every other year positive with an average gain of 5.1%, median gain of 8.6%. And when you look a full year out, there's only been one time since the 80s where we've been negative a whole year after that, and that was the dot-com bubble. So even 2008, we were positive a year after that election. And the average gain has been 16.5%, and a median gain even higher of 21.5%. So it really tells you that, yes, there can be short-term reactions to things, including elections. Markets can be emotional in the short term. But when you look longer out and you take that long-term perspective, it really gets back to, the fundamentals, and our company's growing, our company's making money. And like we've talked about, they're good at doing that. And so the stock market usually gets back to track those stats rather than kind of the emotional reactions of it.
That's really good. I wish we shaded this chart green, because then that would really show the green on the screen as opposed to the red.
Yeah, that would be good.
It's a great view.
All right, now we're going to look at the different years during a 4-year presidential cycle and what we've seen on average with those different years. So for all years, like we've talked about, around about a 10% per year has been the average gain in the stock market for about 100 years. Presidential election years, we all know now that it's been better than normal, and you see about a 11.5% gain during presidential election years. Now, midterm elections, so those off years, those every two in between the presidential election, those have been the worst performers, about 7.5%, but still good, right? 7.5% is still a good return. And non-election years, so these are going to be the odd years where there's no midterm and no presidential election, have been the strongest for the markets with an average gain of 14.5%. So these, again, that will be 2025. We will be going into a non-election year. Last year, we were in a non-election year. And so those have been the best on average. So looking ahead to next year, I mean, we saw the averages 1 year after the election, so that's going for us. And then this is a pretty powerful stat as well, that historically those have been great years. Doesn't guarantee anything, right? But it's still good to look at and keep that in mind.
Yeah, and you mentioned last year was 26%. I look back a couple years, so 2 years previous to that, on the last non-election year before that, it was 28%.
Oh, wow.
So
that was
recently
2021.
That was 2021,
Yep,
and then
right.
2019, it was 30%. So the
Wow.
averages have been a little bit higher the last number of non-election years, which, like you said, is what we're heading into. So that's actually a very good thing.
So it has panned out recently quite strongly with this, the theme of non-election years being great years.
Yeah.
All right, now this one, there's a lot going on here. So I'm going to walk you through this. And this is going to really show us, government action. So really bills being passed and how that affects stock market returns. So the bars that we see for these every 2 years, that represents how many bills were passed. So you can see in 1973, we had almost 800 bills that they actually passed. And the color represents the control, the makeup of Congress. So blue is going to be, Democrat controlled, red's going to be Republican controlled, and then your purple is going to be mixed. And then the yellow or orange dot represents the annualized return during that period. So when you look at this, comparing where the bars land versus where the returns are, it looks pretty random. And that's because it is. There's essentially no correlation with how many bills get passed by the different parties and what the investment returns are. Mm. So if you were ever concerned, okay, there was a sweep, right, or a wave, and a certain party has a lot of control, there's risk they could pass a lot of bills and that could affect things. When you look at the effect on the stock market, it's not there. There's really no correlation with that. So that was pretty surprising and impressive to see.
Yes, and I will also say that that's what we hear of most concern from our clients, that if it's all one way or all the other way, that it will drastically impact the stock market. And I think this is very complex chart, but it also proves exactly what you just said, DJ, is that it's not correlated, it's not connected. So
right. Yeah. And again, these things, it does go against kind of our natural reaction or our intuition, and we totally understand that. And that's normal. It really is normal. But we like to look at the data and see how things have happened in the past. And this one here, we're gonna look at, it's kind of like last time or the last chart where we're looking at, the makeup of Congress and how that affects things. So when you've got a Democrat president, and then you can see the returns if there was a Democrat-controlled Congress, a Republican-controlled Congress, or a split Congress, again, with a Democrat in the White House. And then on the other side, you can see with a Republican president, you've got then the returns that we've seen with a Democrat-controlled Congress versus Republican versus split. So I think a couple things here. One, they're all positive. So that's important to remember. No matter what the makeup is, there could be lots of different ways, right? Markets have gone up. Two, I think, is markets have really liked some, form of split, control. So, when you have one type of president and then some, you can see the split Congress, that's been great for markets. What have kind of lagged is when it's been, all blue or all red. That has been some, on average, lower return. So I think it goes back to, again, it's a democracy, and it's kind of, we're working together, and yes, we give and take, and stock market likes that, historically speaking.
Yeah, it's that accountability and that checks and balance, where meeting in the middle, like this is what we need in our country, is that unity. Yeah. So
I like that.
All right, so that's really what we have for the election specific, statistics. And I want to go through this one though, because I think it's important, always important to remember this, that markets don't go straight up. So we can see that there's been great returns over the long haul, but there's lots of ups and downs, and sometimes there's extended downs, and it can be really hard to go through those periods. But remember that volatility is normal in the short term. It happens. And so what we have here is year by year going back to 1980, and the blue bar is the actual calendar year return. So if you stayed invested that whole year, this is what the S&P 500 returned. So if we look at 1980, it was a 26% gain. Now the orangish yellowish bar is the biggest decline during that year. Because again, markets don't go straight up. So in 1980, yes, we returned 26%, but at some point during that year, we had a downturn of 17%. So imagine that, right? We pulled back quite a lot, and that could have been really scary. Like, oh no, what's going on? usually they're fairly short-lived. And as you can see, we recovered it and ended the year with a great return. So if you just kind of scroll through this, again, if you stay the course, you're going to get those blue bar returns. And if you do panic and emotionally react to the volatility, it's not going to go as well, because volatility is normal. We see these pullbacks along the way. On average, we see 3 different 5% pullbacks in a given year. And again, usually these are very quick, very short. And in addition to the 5-year pullbacks, or excuse me, 5% pullbacks in a year, we also see a 10 to 14% pullback. So again, we usually see a couple short 5% dips and then a kind of a longer 10% one just on average. Yet the average gain for 100 years has been 10%. So they are volatile in the short term, but you want to stick with it long term, stick to your strategy. And that's what we help our clients do.
That's right.
And I had one other thing I wanted to mention. So again, a lot of these numbers look really great, right? They look really, really good. Now, that doesn't guarantee anything, right? We can't predict what's going to happen, over the next few months through the election into next year. We can kind of get some general observations, but nobody knows. No one knows what's going to happen. So there could be volatility, there can be pullbacks. That is normal. The best way to set your investments up to handle the uncertainties along the way is to be well diversified, to own many different types of investments that are going to move in different ways. That's really important. If you have most of your money invested in one type of investment, that can be risky. You want to spread it around. When we go through these downturns, there's usually some type of investment that does a little bit better than other types of investments. And if you're diversified, you're going to always have something that's usually doing okay. And so that's really important. And that's the best way to prepare for these uncertainties is to be well diversified.
Yeah, really, really good. So as we shift into discussions and questions, I just want to remind you to text your questions in to that number there listed on the screen, 458-777-4458. And we'll hang out as long as possible to get all these questions answered. So with that, I think what we'll do is answer some of these coming in. Do you want to say anything, Jason?
Yeah, there were a few that were submitted even before these that came in. So let's start with these, and then there's quite a few. So some people are scared of an election year and hold lots of money in cash and money markets after the election. Why isn't this a brilliant idea, especially with high yields and CDs paying 4 to 5%?
I'll take that one. Well, as we just saw, stock market gains have been really good on average following an election. Excuse me. So if you sit on the sidelines, you do risk missing some of those great gains. And so if it's money that you don't need in the next few years, we would recommend you put that to work. And the chances are it's more likely than not that you're going to have some good gains, over the next year. Not guaranteed, but the stats tell us it's likely.
Yeah, I'll share too. Historically, thankfully, we have 100 years of data that we can look back on. And when we have interest rates of 4 or 5% at money markets and CDs, we know during that time, bonds are going to perform 6 to 7%. Stocks are going to perform 8 to 12%. So it doesn't make sense that you get CDs at 4 or 5% and don't get that corresponding risk return in the other investments over time. And I think that's exactly what we've seen. In fact, it's really fun to see our clients that have fixed income in their portfolio, which most of our clients in retirement, or if they're taking some sort of income, have that, where they're getting that rate of return now, that 4 or 5%, but then they're also getting capital appreciation in that fixed income as the interest rates come down. So exactly what you shared, DJ, where you have to have that diversification with the different types of investments, because they all work differently. So yes, maybe it does make sense that you have some of that short-term cash, but not because of fear of what's going to happen, in the markets. So.
And what both of you are saying reminds me of the importance of having an advisor on your side who's helping you navigate your personal situation, because it can be different. There's different things that people are doing. So you don't want a cookie cutter approach. You want something proactive and specific for you.
We know some pretty good ones too.
Yeah. Huh. I wonder who that might be. I think we already answered this, but so depending on who gets elected, I heard there's a higher potential for recession within the next 12 months. So how do I safeguard against that? But we really saw from the data the whole next year and even the next 3 months on average has been higher. So I don't, based off of what we already talked about, that should not be a concern.
And also if you are dependent on income from your portfolio, then we have our clients set up to withstand the volatility that would happen or the downturn in a recession. So that's already built into the portfolio, if you're taking income from it and need that portfolio to generate that retirement income.
What do investors do when they're really nervous about the markets or the elections? I don't want to bury my head in the sand, but I also don't want to make a big mistake.
That's a good one, especially, all the information that's put out there, whether it be the news or social media, wherever, it can paint a pretty scary picture. So call us and we'll talk you through it. And, again, remember that you're in it for the long haul. You're not investing for just 1 year. We're helping people plan for their future and living, long lives in retirement. And we really take that approach. And, there's election this year, and in 2 years, there'll be midterm elections, and 2 years after that, we'll go through it all again, and on we go. And so we're here to help you navigate that along the way.
Okay, should I just keep reading these questions?
Yes.
Let's do it. Okay. Kamala Harris, good last name, by the way, talks about taxing unrealized gains.
Ooh.
Can you tell me whether this is good for our portfolio in the stock market, and would that even be allowed?
Yeah, I'll take that one. Yeah, because this is an interesting one. This would introduce a new way of taxing. So, it would take a lot for this to get into, into action.
Wow.
And I also, reading more about it, it impacts people with net worth of 100 million. So very small percentage. It would be like, founders of very big publicly traded companies, like, the Amazon, the Googles, the Tesla, all of that. And what it would do is essentially it would have forced them to sell their publicly traded stock, because that is the majority of their net worth, to realize the unrealized gains each year of capital gains. So I think it's very far-fetched that something like this goes into effect. Would it impact the publicly traded companies? It would create the trading, and so it would create more shares that are available to the public. So do you have the demand? And there's a lot of investors in America, a lot of pension funds, a lot of retirees and people in the workforce that are putting money into 401ks. So I can't imagine that impacting things too much. But even if we get to that point, which I doubt we will, it's a pretty extreme way of thinking about it. So what do you think, DJ?
I think you nailed it all right there.
Yeah,
I agree.
Yeah. All right, here's another. We're doing all this, both sides, right? Okay. what do you think will happen to the stock market if Trump loses the election and then refuses to accept the results and instigates another riot series similar to January 6th? Ooh.
So I think, again, like anything that could happen, there can be volatility from these things. I mean, things happen around the world, and the markets, they do react to them, and it's usually short-lived. It's usually short-lived because, again, if we get back to what really drives the stock market forward, it's thousands of companies all over the world, not just in the US, but all over the world. And if they're growing and making money and growing their earnings, the stock market reflects that. So with something like this, or really anything that could happen, again, short-term reactions, but then we get back to the fundamentals, and we likely see nothing different than what we've seen for 100 years, right? I mean, companies would continue to operate and make money, and that's what drives the market performance.
Yeah, it's that chaos, right? It would create chaos in the short term that I have to believe all of us don't want. And I think as Americans, we're resilient. And yeah, even though if it goes off track, I think it has a way of coming back on track. So, the hope is that we all act like adults and lead with love. So we'll see.
Yes, we will. But yeah, what you guys are mentioning too, that's a short-term response. So we're long-term investor. If you're in the stock market, that should be a longer-term investment. And so, is the value of that company, like if we just take one company, for example, did it really drop that low? Just based off of panic, yes. But like you guys are saying, it will normalize to what it should be. Like the value of this company is actually higher. We just have that uncertainty right now.
Yeah.
Okay, what would happen if the threatened tariffs were enacted?
Again, it can have some effects in the short term, and I think we've seen that. I believe it, historically speaking, I think it probably does cause the stock market to decline a little bit initially, because it is a little bit of a barrier to doing business and companies making money. But they will adjust just like they always do. These are things that are out of our control, out of business's control, and they will adjust and be flexible and find ways to continue to grow their business. Julia, do you have anything?
Yeah, the thought is how it impacts, it impacts the profits of these companies. And so much of the future growth, like right now, the market has been growing so rapidly because of expectations of it will continue to grow and these companies will still make profits. And so, it affects the ability of profitability. Does it make them unprofitable? Probably not. It just slows that down. And so as we get quarterly earnings reports and future guidance, we can see that. And then also ensuring that goes back to ensuring that you're invested in a wide diversity of investments. So we have investments that are more those dividend that have low debt, that have high valuations, and then we also have small companies that are more of that high growth potential. So all those different companies will act differently in that environment. So it goes back to having everything spread out.
Yeah.
Yeah, and the other thing, I believe, you guys can correct me if I'm wrong, but at least from the debate, I watched the whole thing. It sounds like there are still some tariffs that were enacted under President Trump that are still there, and I didn't hear that was not the case. So I believe some of that is still happening now. So could there be more, and the impact, like you guys are saying, that could happen. But yeah, businesses are always there to grow and to make money. Remember during COVID when everything was kind of shut down? It's like, okay, what do we do now? We have to reinvent ourselves. Like we got to put the little circles on the floor so that people will stay their distance so they can at least come in. You got to wear a mask. So there's a bunch of different things that happened so the businesses could still be profitable for the end investor.
Yeah.
That's a good point, Jason. That's a great point. Yeah.
Okay, let's see. Can you explain what the Fed rate cut means for an average investor? And do you think they'll continue to cut rates?
Ooh, good
It's a great
question.
Good one. Yeah, I love that. So, I mean, it means a couple things. So, I mean, one is obviously lower rates, lower cost of borrowing. So, businesses and individuals can access capital easier. It's a lower cost to them. So that can help spur economic growth, which can be a good thing for, then the stock market, more money being spent. That's economic activity. And then for people who have some conservative investments like bonds, and Julia mentioned this before, that can be a good thing. As rates come down, bonds actually get an increase. So bonds had a tough go as we were raising rates, but now we're in this new chapter as the rates are starting to come down, and that can be a really positive for people who have existing bonds. So that can be a good thing. And right now we're in that situation where the Fed has basically said we're not too concerned with inflation. We feel like we got that covered. So now they're shifting to try to maximize employment and help the economy grow. And that's why we saw that big half rate cut. So, we don't know what the effects of these higher rates will be going forward. But things have worked out pretty well so far. And the Fed is they're saying, hey, we did our job so far. We got inflation down. We haven't gone into a recession. Now we can start to loosen things up, which can be good for the economy and the markets.
What would you guess a year from now where rates will be? Will they continue to cut, DJ?
Oh, you're going to put this on a webinar that's
and
recorded.
This is recorded.
Oh gosh, I don't even want to play that game because nobody knows, right? I mean, who knows what they will do? And think they could get new data along the way, right? 6 months from now, we could be in a different ballpark where they have new data and then they're doing something different. It's going to be lower, right? I'll say that. Very likely we're going to be much lower than where we are now.
I'll say that I don't think it'll be down to the 2% mark, which is where they want it to be a year from now. I doubt they'll cut them that drastically in a year's time.
I agree. Mine will be like 1% more from where we're at today.
Yeah.
Okay.
Yeah. So, all right, we have more questions coming in, but what we're going to do here is if you want to talk to an advisor specifically about your investments, your situation, if you have concerns, if you're worried, we want to help. If you are a friend of ours, what I mean by that is not currently a client, but you're here today listening in, we would love to help you. We would love to give you a second opinion, see how we can just be your guide and look at your investments just to ensure that you are set up to go through the volatility of what's coming here. So I would encourage you to text election to 458-777-4458. And then we will either send you a link to get scheduled with an advisor or just facilitate that scheduling with you there. I will also share here, our broker dealer is LPL Financial. All of our licenses are held, with our broker dealer LPL. They're a great partner. You can read about all of these disclosures. I will also say if you have trouble sleeping tonight, you can take a screenshot. And with that, we will come back to more questions here. I thought I saw a couple more come in, Jason.
Yes, there's one I see here. So yeah, if you do have a question, please do text it in so we can answer it here. These are great questions. Okay, do you think the Tax Cuts and Jobs Act will expire? And how should investors prepare for that?
Oh, that's a really good question. You want me to take it?
Sure.
All right. So yes, the Trump tax cuts that were put into place in 2018, is that right? That those are set to expire in 2025. So it'll be interesting to see how this plays out. I think across the board, things that you could consider are specifically Roth conversions. So if you are in a tax bracket now that could be going higher. So for example, if you're in the 12% now, that would revert back to the 15%. So it may make sense for you to convert money from a pre-tax IRA into a Roth IRA. Now the downside is you have to pay taxes the year you do that, but you may want to fill up that 12% tax bracket to take advantage of that 12% tax break in 2024 and 2025. That's set to go and stay through all the way of 2025. And then the other big thing is we don't know what's going to happen with estate, like the federal limits for your estate plan, the total assets that you can move to the next generation is most likely going to be cut in half. And so right now you have a use it or lose it, where if you do any type of big gifting strategy, you can use up that exemption you have in 24 and 25 to go up to those bigger limits. So you probably have to have a net worth of more than $7 million for that to make sense for you. But that is something that our advisors can work with you on and kind of come up with a proactive strategy. I think for the most part, we've been taking this wait and see approach because we still do have time. And I think we'll know a lot more once we know who our next president is, and then be able to kind of pivot and go into some planning strategies the end of this year and next year. So that's my thoughts.
Yeah, I mean, it will take still an act of Congress to make those changes too. So president will be important, and who's in Congress. So
yeah,
if I had to guess, I'd say it probably will expire and we will revert. That will be my thought, but anything could happen. Yeah.
And then what the if and when that happens, the standard deduction was going to get cut in about half.
Yeah.
So more people may itemize, and that you'd want to keep track of those things that you may not have been doing in the past. Now, obviously, that's not until it happens, but be another thing.
Yeah, that's a lot more paperwork and a lot more accounting for
exactly.
I think 90% of Americans take the standard deduction. So who knows? Maybe they'll come up with a middle ground there where they keep that, because I think that was, helped a lot of the CPAs and the tax preparers, and also Americans, keeping it simple. And so we'll see.
Let's hope.
We like simple.
Yes, simple's good.
But again, do you think that's connected to the market? I'm trying to think if that would have any correlation, the taxes, because did that include the corporate tax? I don't know if that corporate tax rate reverts back to anything. Can't remember.
I'm not sure.
Yeah.
Not sure either. Yeah. Great. That concludes our questions in the queue.
All right. Well, good discussions. Thank you to all of you tuning in today. If you're catching the replay, please still use this, text your questions and reach out to us. We're happy to sit down with you and walk you through any concerns, and just really make sure that you're feeling confident in your personal strategy. Don't have to feel confident in the government, but you got to feel comfortable or confident with your strategy. So we just hope that you have a good holiday season. That just feels weird to say coming up, but we would
cozy.
Just say it. Go ahead, Jason.
It feels cozy though.
It feels cozy
to say that. Yeah.
Yes. Well, thank you to both of you as well, but go ahead, Jason.
Oh, just one more thought that, no matter what happens with the elections, we talked about with the markets, but even if you think about it on a personal level, it is, 4 years of a time, and there will be another change. Of course, in between 2 years, there's other changes in the government, but it is just a time. So no matter the case, we can make it through any stint, no matter what's happening. We're very resilient, as Julia, you mentioned earlier. So
one of my favorite sayings is, "This too shall pass."
yeah.
Mhm. Mhm.
All right. Well, everyone have a great day, and we'll see you on our next webinar.
Thank you.
Thanks. Bye.
Bye.